What's going on, everybody? Andrew Ferguson here, back with another episode of the Buy Back Your Life show. Today, we're talking about what stock options actually are. We're going to go through call and put options, get into them in detail, and give you guys an idea of just how they work in the actual grand scheme of stock market trading. And as some of you may or may not know, these are what I use day to day to make my money that I live on. I don't have a regular full-time job. When I hit a certain point with my trading, I was able to retire on stock options. So if you want to know a little bit more after this episode about what stock options are, how they work, and how I use them, make sure you guys go to www.tradingoptionsdaily.com/webclass, where I give a free presentation online virtually of how stock options work, 3 different ways you can use them to hack the stock market to retire from your 9 to 5, and just a general kind of principle of what my trading looks like on a day-to-day basis. So that training is free. Again, tradingoptionsdaily.com/webclass. But let's get into what stock options are actually today. Stock option 101, okay, on the Buy Back Your Life show. And if you've heard stock options before, maybe they've gotten kind of a bad rap. I know a lot of people think of them immediately as like, bang, stock option, super risky, or they think of like the stock that people are compensated with when they get a job and the job comes with stock options. That's a different kind of stock option. That's like an employee stock option. These are stock options, otherwise known as derivatives of the actual stock market. So you have actual stocks that trade up and down. The stock prices of like Apple, Microsoft, just companies in general, or ETFs, index funds, they go up and down all the time. Currently, we're in quite the down spell this year, especially, and now this past couple of weeks has kind of been a pronounced kind of down spell or bear market. But stock options are different. Okay, they're different from the stock market. They're different from stocks. They are built off of stocks, so they're derivatives of the stock market. And I'll get into that and I'll explain what I mean in a little bit here. But they are a little bit different than the employee stock options. They're a little bit different than stocks. They are influenced by the stock price, by a thing called time, and some other stuff. And let's get into them right now. Like maybe you have heard of them, maybe you haven't. That's okay. We're going to get into it. I'm going to explain into it hopefully today on the show as if you were a 5-year-old. And again, this is what I use day to day on my phone, 30 minutes a day, one app, looking at charts, looking at companies, and just building out kind of my net worth with a stock investing kind of portfolio through my phone. So literally when I was learning how to do this for the first time, this is before I had any training done. I didn't take any courses. I didn't know anything. I didn't know what a stock was at the time. This is way beyond kind of my comprehension back then. I was literally looking for like how to do this like a 5-year-old, just give me the basics. And that's what I literally Googled the first time I tried to do this, and just kind of started reading articles from there. And I'm slowly compiling kind of a list of articles for you guys to read as well. If you guys haven't checked that out yet, you can hop on over to tradingoptionsdaily.com/articles. And I'm slowly going to build a library of articles for you guys to hopefully increase your stock investing knowledge and just give you guys a place to go. If you guys have questions, you can go to the websites to look at the posts, look at the information, kind of get an idea, like a one-stop shop of how to get your kind of training and your terminology up with those kind of articles. So anyway, back to stock options 101. Okay, here's what they are. Okay, by definition, a stock option is a contract that gives the buyer the right, but not the obligation. Okay, it gives the buyer, so there's always a buyer and a seller. It gives the buyer, whoever's purchasing or paying for the stock option to control it, it gives them the right, but not the obligation to buy or sell shares of stock, always in 100 share increments. Okay, every stock option contract is made up of 100 shares. So the buyer purchases the right, but not the obligation to either buy or to sell shares of stock at an agreed upon price on or before a defined expiration date. So there's a lot of unpack there. We'll get to that in a second. Just give me 1 sec here to go through what the seller does. So the buyer is paying basically for the right to control 100 shares. And at the end of the expiration date, there's a defined timeline. Maybe it's 30 days, maybe it's 2 months, 3 months, maybe it's 1 week, maybe it's a year. There's different kind of expiration dates for all these contracts of stock options, right? And the buyer is paying money to the seller of the contract, okay? And by paying this money, they are essentially buying the right, and again, not the obligation, but buying the right to either buy or sell shares from or to the seller within that expiration date. So if they have a contract that's in place for 30 days, the buyer has 30 days to decide if they want to either buy or sell shares, depending on what type of contract it is, okay? On the flip side of that then, there's one buyer, there's one seller, okay? And we're digging into this stuff now. The seller is the one who is going to get paid for selling the option contract, right? And they are getting paid because they're taking on risk of either having to potentially buy shares from the buyer of the contract. Okay, they're going to, let me rephrase that. They're going to have to purchase shares from the buyer of the contract. Okay, I don't want to go, the buy is confusing. So the buyer purchases the right to sell shares. The seller of the contract, right, would have to then potentially buy those shares or purchase those shares from the buyer of the contract. Okay, and the seller is taking on the risk of having to potentially purchase shares or sell shares at an agreed upon price within that 30-day or that expiration date. I keep saying 30 days because a lot of my contracts that I sell, I'm always the seller in my opinion, in my experience, and I sell these contracts, and usually it's a 30-day window, and I'll explain that maybe on this podcast a little bit later, maybe not. If you want to understand why the window changes in the different increments of time, definitely go check out that free web class I talked about at the beginning of the episode, because it goes in depth. I'll go in depth in there and show you exactly why it matters when you sell these contracts if you're going to be a seller. If it's a buyer, it's a little bit different. But okay, if it's a little bit overwhelming now, don't worry. We're about to go 5-year-old mode here in a second. I just want to cover a couple more things with you guys. And there, like I say, there's different ways you can buy or sell as the buyer. You can have shares assigned to you or put to you as the seller, or you can actually have shares called away from you as a seller. So there's two types of options you have to worry about here. So stock options are made up of a buyer and a seller, okay? And if you have a call option, what a call option does, it gives the buyer the right to purchase 100 shares of stock from the seller at that agreed upon price, okay? And the seller, on the flip side, they are getting paid that cash right at the beginning. They get paid the cash to strike the deal, okay? Known as premium in the stock investing world, and they're paid that immediately. The buyer forks over cash electronically, whatever, through the trading platform they're on, and they will match up with the seller. The buyer likes the terms of the contract. The seller likes the terms of the contract. The buyer will then pay the seller, and the contract is formed and executed, and the order is filled. And that seller of the contract gets paid immediately. And with the call option, okay, the seller sells the call option to the buyer and then takes on the risk of potentially having to sell 100 shares of stock to that buyer at the agreed upon, what's known as a strike price, which governs the price of the contract. Okay. Now, on the flip side, we're going to go through this as an example. There's something called a put option. Okay. And a put option, what that thing does, it gives the buyer of a put option the right to sell 100 shares of stock to the seller at an agreed upon price. Okay. The put option is different from the call option, right? The put option gives the buyer the right to sell 100 shares or put 100 shares to the seller of that contract at an agreed upon price. Okay. The seller, again, is getting paid to take on risk. Immediately as the contract is formed, they get paid to sell the put option contract to the buyer. Okay. And then the seller of the contract takes on the risk of having to buy 100 shares of stock from the buyer at the agreed upon strike price as well. Okay. And again, we've been talking about a couple of things here: call options, put options, stock options, strike, time in force, the expiration dates. Okay. Every contract, you guys need to understand that every stock option contract, it has an expiration date. That is part of the contract that is agreed upon between the buyer and the seller before it actually is finalized. Okay. So think about if you were like on the playground with your friends and you're trading, let's say we're going back in the day and we're trading Pokemon cards, okay? And your buddy's got Pikachu and you want Pikachu bad, okay? You're the buyer, they're the seller, and you say to them, okay, I will buy that Pikachu card from you, but I'm only gonna give you till, let's say, the end of the week to decide, okay? Then that becomes the expiration date. After that point, the contract would be null and void, okay? So that's just kind of an idea of how expirations date work, just on a very like basic level. So every stock option contract has an expiration date. It governs when the contract is like the last possible date for the contract to be valid by. And on that actual expiration date, the buyer of an option contract has the ability to exercise the contract and either buy or sell shares to the seller. So on expiration, or even like a day before the expiration date, like if it's the expiration date, let's say it's December 25th, just Christmas Day. Okay. And we'll not worry about the years here, but just say that's the expiration date, December 25th. On December 25th or before, okay, whoever bought the option contract, the buyer, is going to have to make a choice on that date. That's the last possible day that they can go ahead and just do something, either buy or sell shares based on what kind of contract. If they bought a call option, they would be buying shares on that date. If they bought a put option, they would be selling shares on that date. So they have a choice to be making on that date. And if they don't do anything and the expiration date passes with the buyer making a decision, sometimes that does happen. If it's working out in their favor, that maybe they're better off not buying or selling the shares that they control. The contract expires worthless and nothing happens. The seller keeps their money, the buyer loses their money, and then away you go. So sometimes that happens as well. But the other thing to be aware of, we've talked about, is the strike price. So the strike price of each option contract, right? It's just the agreed upon sale price between the buyer and the seller. So for example, like if Apple's trading at $140 per share, the strike price could be 130, 110, 100, 90, 80, whatever the buyer and seller agree on. It could be 150, it could be above, below, at the strike, right at the stock price. It doesn't matter. There's all these different kind of option contracts floating around out there with different strike prices. And all it does, it just, when that deal is struck between the two parties, that's where the contract is agreed to. That's what the contract price that's either bought or sold at. And that just, it represents what the shares will be exchanged at if that does happen at that strike price that the buyer and the seller agree to, okay? So breaking it down a little bit further for you, let's digest what we just said. We went through stock options, went through call options, went through put options. Let's go into a little bit more of a kind of a broken down example for you guys to hopefully give you more of that 5-year-old version, and we can get as close to that as possible, okay? So let's do that. So for this, let's say your insurance, like everybody has insurance, right? Maybe you pay it for your car, maybe you pay life insurance, house insurance, whatever. You probably have insurance on something in your life. And if you don't, look into that, because at the very minimum, life insurance is important, depending on what stage of life that you're in. So let's take it from there, okay? And let's compare that to what happens with a put option, okay? So we're gonna leave call options alone right now, and we're gonna look at put options and go through that, okay? And so in the insurance example, let's say you pay your insurance company $50 a month, okay, for an insurance policy. And the value of that insurance policy, we'll say it's valued at $500,000, okay? So every month you're forking over $50, okay? And you have insurance in the form of $500,000, which the insurance policy covers you, okay? And if you're healthy and you're fit, you're going to the gym, you're working out, you're getting big, like feeling good, right? Eating healthy, all that stuff. And over the course of the month, nothing happens to you. You would have paid $50 and you would have received no return on that money aside from the good health that you hopefully had, okay? And this is it's the insurance, that's what we call it. It's just there in case something goes wrong, right? So the insurance company gets paid that $50, and for the month, they take on the risk, okay? Remember that, you're paying the insurance company, so you're buying the insurance, they're selling you the policy, you are paying them $50 upfront for the month, and then the insurance company takes on the risk of you maybe being injured, maybe you're going to put a claim in and actually access some of the money in that policy, right? They're taking on that risk, because if you do, then they have to pay out that $500,000 or part of it to cover some form of medical expense for whatever reason, okay? I'm not going to get into what the details are, but that's how it works, right? You pay the premium $50, they give you a policy saying, hey, we'll insure you. And obviously insurance, especially if it's health insurance, made up partly based on your age or your health habits, if you're a smoker or not. If it's a vehicle, it's what kind of vehicle it is, how reliable is it, does it go fast, does it go slow? All these kind of things come into play in forming the actual contract at the $50 value and the $500,000 policy value, okay? But just breaking it down, you as the buyer of this contract, you are paying for protection of your health, okay, in the life insurance one. And the insurance company, as the seller of this contract, they're getting paid again to take on the risk of potentially having to buy you healthcare if something goes wrong, okay? So you're buying for protection, and the insurance company is selling and taking on the risk. They're getting paid, and they're betting that you're going to be healthy and fine. They won't have to pay the premium out at five. They're not going to have to pay out that $500,000 policy. They're just going to collect that $50 month over month over month and keep it going. All right. And like, let's say this contract is in effect, like most of them are, for 1 month. Like we sign deals for like life insurance for like a year-long policy. Let's say in this example, it's there for 30 days. Okay. It's in effect, and you pay $50, and that gives you 30 days of coverage. Okay. And then after that 30 days is up, or the contract would expire, let's say, you would then have to pay another $50, and just re-up that contract, get it in place again for another 30 calendar days, right? Does that make sense? Hopefully, okay. So that's the expiration date in this example. And then the agreed upon value or the strike price in this example of the contract is $500,000, okay? And that's what the insurance company would have to pay you in the event of a claim. So you agreed to that, you covered, like when you're picking coverage as a buyer of insurance, you can say, okay, I want $100,000. It's gonna be a little bit cheaper. It's gonna be like $10 a month. I want $200,000 of coverage. I want to pay only $20 a month. And then you go up from there, 300,000 is 30, 400,000 is 40. And you settle on $50 a month, you can afford that, okay, hopefully. And then you go, $500,000 is my coverage. So you just bought 500K of coverage, $50, that's your trade-off, okay? And that's what the agreed upon strike price was. You're saying, I got $50 a month, how much insurance can I get? The insurance company says, well, we can give you 500,000 for that month. You say, is that okay? Yes, it is. Then you create this contract based on that amount, and that $500,000 amount is the strike price. Your $50 is what you're paying the cash to the insurance company, okay? And this is exactly how a put option contract works, okay? You, the buyer, are buying a put option, okay? You're paying the seller of this, in this case, the insurance company. You're paying them $50 a month of cash, which is known as premium again, for 30 days, 30 days being the expiration date of the contract. It's enforced for 30 days. So you're paying, you, the buyer, are paying the seller, the insurance company, $50 for 30 days of coverage in the amount of $500,000. And again, $500,000 is a strike price. So when you buy a put option in the stock market, you are essentially buying insurance for your portfolio, okay? If nothing bad happens over 30 days, you're out the $50, okay? And it is what it is. You just bought some insurance, right? For yourself. Just like if you had health insurance and you're healthy for 50 days, okay? You just lose out on that $50, but you were covered in case something bad happened. Like we've seen now to start the year, 2022 hasn't been a great start to the year for the markets. If you bought a put option on a certain company and the markets got injured, or in this case, they declined, okay? Just like maybe your health declines in the healthcare example, then you get to put a claim in and you get paid either some or all of the $500,000 in that policy. That's what a put option is. That's how it works, okay? So you're paying for the insurance. If nothing happens in 30 days or whatever the time period is, we'll say 30 days for our example. If nothing happens, you fork out $50, you get no return. What you do get though, no tangible return, let's say, but you do get the peace of mind that if something were to happen, you would then get to benefit and there'd be some reward for you taking on that risk, okay? If nothing happens, no like tangible reward. If something does happen, if you get injured, if the stock market declines, right, then you're making some cash, and on the downside kind of movement, you're protected. Hopefully that makes sense to everybody. That's a put option contract. That's the easiest way I can kind of explain it with insurance, okay? So think about insurance, life insurance, if you're looking at a put option contract. And just to mention that you can be the buyer, okay, in the stock market, you can be the buyer and you can be buying that insurance, or you can actually act as the insurance company and sell that insurance to somebody else, okay? Again, you're on the hook for potentially having cash in your account to pay out and buy shares, but you end up buying shares at a discount, which is what I like to do. That's how I like to operate. I like to sell a put contract. So I like to act as the insurance company, and like 75, 80% of the time, I know my odds going into a trade that 75, 80% of the time, I'm just gonna get paid that $50 cash month after month after month. And 20% of the time, yeah, I'm gonna have something that's gonna happen in the market. The markets are gonna decline, and I'm gonna have to buy some shares. And in this case, like when the markets are kind of injured or declined, you would then pay the buyer of that contract the money, you would buy shares, and that's how you kind of take on that risk as a put option seller, okay? So you can be a buyer, you can be a seller, it just depends on what kind of side of the fence you want to operate on. I like operating on the side. There's a reason why insurance companies are around. You just keep paying them and paying them and paying them, and the odds of you actually getting an injury are pretty low. So they just keep compiling the cash and just keep building up that cash reserve. That's how I like to operate. Flip the odds in your favor and act as your insurance company, okay? Moving to call options. We're going to explain it as if it was a roulette table. And I say roulette because I used to frequent the casinos a little bit as a younger man. Didn't have a great time there. Made some stupid financial decisions, but looking back on it, it was a good learning and growth experience for me. But I do have the knowledge of that, what happened during that time. So I do know roulette pretty well. And we're going to go into roulette example. If you guys don't know what roulette is, that's okay. I'll break it down for you. Let's go through stock options like roulette, the casino game. So in roulette, maybe you've seen at the table in the casino, okay? It involves placing a bet, or there's multiple ways to bet, but just keep it very simple, okay? There's a wheel, a little white ball is spun around the top of the wheel, and eventually it'll land on a number, okay? And there are 0 to 36 plus a double zero category. So there's technically 36 numbers on the board, 38 actually, if you go to count zero as one. And if you actually are able to put your bet on one of the numbers and you hit, or let's say you put it on 10, right? I think 10 is black. I don't actually know. Let's say it's number 10. You put it on 10 and the ball lands on 10. Whatever you put down as your bet, you get paid out 35 times. So if you bet $1, you get paid out $35 plus your original $1 bet comes back. So you get $36 back, okay? If you were to put down $100, okay, you'd be making $3,500 in profit. So like if you hit it, it can be big, but you've got a 1 in 38 chance of hitting it. And the percentages aren't very good if you do that, right? Obviously. So if you miss, the casino keeps your money, and that's how it works. And in this example, okay, in a call option, if you're buying a call option, you are essentially placing a bet on the roulette wheel. You're taking your stack of chips and you're going, I'm hoping I can guess what number this is going to land on. And if with a call option in the stock market, you're doing the same thing. You're hoping you can bet when a stock price is going to rise. Because if you buy a call option, you are hoping 100% for the stock price that you bought it on to rise and go up. Okay, so let's say you bought it on Apple. You bought a call option on Apple. You would then be, as soon as you bought that, you thinking, okay, I'm buying this right now because I think Apple's stock price is about to go up. Okay, that's what you're doing. And if you do that, you have to then obviously pay the seller of the contract, just like you would with a put option, right? You're paying the insurance company in our put option example. If you're buying a call option, you're paying the casino, you're putting that money on the table. The casino is going to get paid that. Potentially they have to pay back out if you win, but if you don't, they're keeping that money, okay? And if you get it right, again, the rewards can be huge, okay? If the market goes up when you buy a call option, you're controlling 100 shares of stock, right? Every option contract made of 100 shares, you're going to make some money. And it's the equivalent of hitting that number on the roulette table. You're getting like, you're not going to get an exact 35-1 return, but you can make some serious cash. And when you see kind of these crazy stories of people running up their accounts, a lot of times it's just people getting very, very lucky with call options and just making a ton of money in a bull market and just getting the timing right. A lot of times it's from dumb luck because a lot of people don't know how these options work and they don't know how to use them properly. And you can really blow up your account very quickly if you use them in the wrong way. So that's the risk side that kind of people kind of get a little bit turned off of stock options, because there are ways to blow up your account if you don't use them properly. If you use them appropriately in the right way, they can be a very great asset to your wealth building in your stock account. But anyway, okay, if the call option buyer guesses right, the market and whatever stock price or stock they sold or bought the option on goes up, okay, they make money. If the market goes down, however, or stays the same, right, it's the equivalent of missing the number on the roulette table. And then the seller of that call option, being the casino, is going to keep all the premium and it's going to not have to pay anything out to the buyer of the option. So if you put your bet on the roulette table, you buy that call option and it hits and you hit your number, yes, you make very good returns. But for that to happen, you have to get the direction right, and you have to know exactly when the stock price is going to go up, which is very, very difficult to do. Okay, super hard to do. And that's why a lot of people buy these call options. Number one, because a lot of them can be cheap, and it's kind of a gambling mentality. I'll just put $100 on, let it ride, see what happens. But a lot of times there's like an 85-90% chance it's going to do nothing, and they're just letting that thing ride without knowing the odds, and they just end up losing the cash, get turned off from stocks, and think, oh, stock options are risky, I don't want to know what I'm doing, so they just say screw it, like they're done. Okay, so that's not the way I would recommend using stock options. There's a time and a place for that, for buying calls. It's the hard part is like not knowing where the stock market's going to go, right? If you have to get direction right and it has to go up, you have to know with like full confidence where it's going to go. And there's no possible way of doing that. Like we have best guesses and assumptions and chart reading, and even like the best traders in the world still get it wrong. I get it wrong all the time. I think it's going to do one thing, it does another thing. Like that's the way the market works. Like that's what the game is. So the game is really just about being responsible with your income in what you're putting up to risk, and trying to maximize the odds that work in your favor. So if you know that you can sell stock options and have like a 75% chance of winning, or you can buy stock options and have a 25% chance of winning, which way are you going to go about it? Do you want to have a 35x return with a 25% chance of it happening? Or do you want to get a 3x return with a 75% chance of probability? That's the kind of game you're playing in your head if you understand how stock options work. And again, let's go through the way that I do it to give you guys some perspective. Like I said, there's tons of ways you can do. You can buy calls, you can sell calls, you can buy puts, you can sell puts, you can combine those two. You can buy a call, sell a put in the same contract. And that gets into things called spreads or iron condors or butterflies or all these different kind of maneuvers that you can do, synthetic trades. And you don't have to go into that level of detail as a beginner. Maybe you just want to sell one put option or buy one call option, just try it out and do it in a paper trading account, get the feel of it, understand what's happening so that your money's not at risk in real life. You do a paper trade, right? That's what they're there for, to practice and understand what's happening in your account before you actually go and put your live cash at risk. But anyway, like I said, hundreds of ways to trade stock options, okay? And everybody has their own way of doing it. I have my way, and this has been successful for me. And the way that I do it is, again, is I sell put options and I act like the insurance company, okay? I pick a list and I have some great resources for doing that. I've kind of gone through a process and I have a defined kind of list, boom, step-by-step way of kind of picking companies that I believe in and how I value companies. Again, there's multiple ways to do that too. And kind of everybody has their own kind of form of what works for them. I just know it works for me, okay? And then I have my list of companies. I don't stray too far away from that list of 8 to 10 companies. And I get paid cash upfront in the form of premium again, as the insurancer. I get to sell those contracts after 30 days, okay? If the stock price goes up a little bit, right? Goes up a lot, stays the same, or even goes down by a little bit, but stays above the strike price of the contract, I get to keep the premium free and clear. Okay, there's no downside risk there. The only time I have to buy shares of stock, which is my worst case scenario, by the way, is when the stock price actually drops significantly. And I always build in, like, I always have a buffer, right? If I'm selling a contract, and again, let's say an Apple's trading at 140, and I sell a contract, I sell a put contract, I'm essentially taking on the risk of having to buy 100 shares of Apple at whatever the strike price is. So let's say the strike price is 120, okay? So that contract strike price is 120. Apple's trading at 140 today, so it's got to go from 140, drop below 120. If it does that, then I have to buy shares at 120. But I'm okay with that for a couple of reasons, right? One, I like, in this example, not that this is stock advice, but I like Apple as a company, okay? In this example, I believe in them long-term. I've done my research on them. I know who runs the company. I know how they make their money. I know what the revenue streams are. I know how much money they made last couple of years. I know if they pay a dividend. I know where the stock price has been. So if it is at 140, the day that I sell that contract and it goes down to 120, well, in my mind, if it's a good company that I want to own anyway, that's great. I just got a $20 discount on the stock price, buying it at 120. I still have to pay that cash out and pay the buyer of the contract for those shares, but I just got a $20 per share discount on 100 shares. Okay, that's powerful stuff. That's a $2,000 discount for the stock price currently was. So if you wanted to go out as a buy and hold investor and buy 100 shares of Apple, like an example, today you go buy it for 140 bucks a share. There's 14 grand US you got to pay. I just bought it for 12 grand and I saved myself 2,000 bucks. Okay, if the stock price declines. If it doesn't, I got paid 100 bucks, let's say. I sold the contract after 30 days and Bob's your uncle. I keep the money, don't have to buy any stock. Just go do it again. Just repeat like the insurance company does, right? So the way that I do it, it's beneficial that way because it allows me to trade in like 30 minutes a day is my mantra. Sometimes even less than that, depending on what the market's doing. And I don't always have to be checking the charts and checking out stocks and just researching like hot market deals that you hear from just kind of traders or inside information guys like on CNBC. I don't have to do that. I know my 10 companies. I don't stray from that list. I know what stocks I want to own. I know what price I want to own them at, and I sell contract to do exactly that. If I don't have to buy the shares, again, only 20% of the time that I do, I buy the shares. They're 80, 75% of the time, I just get paid that premium over and over and over again on repeat. And away you go. I keep it simple so I can spend my time doing things like cooking chicken wings. I love trying different chicken wing recipes. Camping with the wife. Shout out to Sarah. We just did a whole kind of refurbish on our tent trailer. Changed the caulking, changed the waterproofing on the outside, changed all the inside kind of stuff, junk out. We just did a whole big thing. Got it ready to go for the camping season. So I like to do that kind of stuff, right? And then bring Dash and Jax, the puppy pals, along, and just go and do that in camp and travel and build relationships with friends. I don't want to be sitting in a chair 14 hours a day like a trader looking at the stock like market. I want to be able to do this, live my life, have my time freedom, go anywhere I want to, and just bring my phone with me to be the thing that makes me my money. So that's why I do it this way. If you have to buy options, it's more research, it's more time, it's more being plugged in, it's more just always kind of being at the beck and call of the market, looking at all the kind of charts in real time, and it's day trading. And like there's different ways to do that successfully, people do, but it's just not what I want to do, not how I live my life. So if you're kind of on board, again, with kind of learning a way to do it in a small time commitment of 30 minutes a day, I recommend go check out my next online virtual kind of presentation on it. I walk through exactly how the strategy works. It's real time, it's about 2 hours long. It's via Zoom, okay? It's at tradingoptionsdaily.com/webclass. And you're gonna see exactly how stock options work in real time. I'll show you some examples. We'll chat a little bit with some people that I've kind of helped teach this stuff to in the past. And you kind of get just like a pull back the curtain, look behind the Wizard of Oz and see what's actually really going on. They're not scary. They don't have to be that scary. Hopefully you guys understand a little bit more now the difference between call options, right? The difference between a call and a put option, what a strike price is, what an expiration date is, how they kind of work together. And if you guys want to know more, reach out. I'm always happy to connect with other listeners, right? If you guys are having trouble at least understanding this kind of stuff, keep coming back to tradingoptionsdaily.com, keep emailing, keep kind of connecting, Facebook, Instagram, right? Whatever, send me an email, Andrew@tradingoptionsdaily.com. Be happy to kind of answer any questions you want. If you want to see any articles on the actual kind of in the blog section of the website, if you want to go a little bit more in depth, check this out, check that out, give me a recommendation, hit me up, let me know. Hopefully you guys got some value to this one today out of this episode. Again, stock options 101. This is how I make my money day to day in the stock market. If you want to learn more, learn more. If not, I hope I enlightened you into what they are and at least took some of the stigma of this being too risky or too kind of high risk kind of maneuvering in the stock market. It's not that difficult. It's a little bit more advanced than buy and hold investing. It's a little bit more advanced than just picking one company and going with it, but you can understand this stuff as a beginner. It does not take a huge time commitment. There's a couple of books I'd recommend you guys start reading with. If you want to know what those are, just connect with me on Facebook, Instagram, whatever I said before, and just kind of go through and just ask some questions. If you want further resources, be happy to share. Check out the web class again, and I will catch you guys on the next one.